New Jersey is finally reaching a breaking point, and in 2026, the long-held belief that home values could rise forever is falling apart right in front of everyone. What many assumed was an unstoppable market is now showing unmistakable signs of cracking. For years, homeowners across the state proudly watched their property values climb higher and higher, convinced that this housing market was somehow immune to the normal economic forces that eventually slow every boom. Now, however, the reality is impossible to ignore. The highest property taxes anywhere in the country, paired with a buyer pool that has largely stalled, are putting enormous downward pressure on home prices and steadily pulling valuations lower. At the same time, available inventory is pouring onto the market at a pace not seen since the aftermath of the Great Recession. Many owners who once refused to sell for anything less than top dollar are suddenly rushing to list their homes, hoping to escape the crushing cost of mortgages, taxes, insurance, and ongoing ownership expenses before conditions worsen. The full picture only comes into focus when you follow the story all the way through and watch how each of these housing markets continues to unravel. So buckle up, check your mirrors, and let's pull out of the driveway, because our journey begins with the city ranked at number 10. Number 10, Vineland. Leaving the busy urban centers behind, you head south into Cumberland County, where Vineland presents a very different picture. What was once viewed as an affordable alternative with plenty of space is now being squeezed by a harsh economic reality that grows more obvious with every passing month. Unlike some markets where prices are slipping because of higher interest rates alone, Vineland faces a much deeper problem. The local economy simply lacks the strong employment base needed to justify the home prices many sellers continue to demand. Without major economic drivers creating steady demand, those elevated price expectations are becoming increasingly difficult to sustain. As you travel along its wide roads and past large residential lots, one thing quickly stands out. The wave of remote workers that briefly fueled housing demand has largely disappeared. With that trend fading, very few buyers are willing to make the long commute from this part of South Jersey, and the market has lost one of its biggest sources of momentum. Housing data reflects that shift with remarkable clarity. Figures from the United States Census Bureau show that population growth has slowed to nearly a standstill, removing one of the most important factors that typically supports long-term housing demand. As a result, local market reports indicate that the median home price has fallen by approximately 5.5% since the beginning of the year. The challenges extend well beyond declining prices. Home sales in Vineland have dropped sharply, with transaction volume down 28% compared to the same period last year. According to the New Jersey Association of Realtors, activity has slowed to the point where the market feels almost completely frozen. Financial pressure is also becoming increasingly difficult for existing homeowners to hide. Data from CoreLogic shows that mortgage delinquency rates in this area have risen to 4.2%, placing the region well above the national average and highlighting growing financial strain. Number 9. Perth Amboy. Pointing the car back toward the northern industrial corridor of New Jersey, you arrive in Perth Amboy, a historic waterfront city in Middlesex County. For years, this community was viewed as a place full of unrealized promise. But in 2026, that optimism is giving way to a painful market correction as affordability runs headfirst into economic reality. Driving through its tightly packed residential neighborhoods, it's easy to see why the market has become so strained. Perth Amboy has long depended on working-class families to keep housing demand strong, yet higher mortgage rates and stubborn inflation are placing enormous pressure on that buyer base. The very people who traditionally fueled this market are finding it increasingly difficult to afford a home. The city's hopes for continued revitalization are now colliding with the financial realities of today's economy. Rising borrowing costs have dramatically reduced purchasing power, and the numbers illustrate just how quickly conditions have changed. According to housing activity tracked by the Federal Reserve Bank of New York, mortgage applications within this zip code have plunged by roughly 35% over the past year. Many prospective buyers simply can no longer qualify for loans at today's home prices and interest rates, removing a significant portion of demand from the market. That shift has forced sellers to begin adjusting their expectations. Listing data from Trulia shows that the median asking price has fallen about 8% from its recent peak, effectively wiping away nearly 3 years' worth of price appreciation. Signs of financial distress are becoming more visible as well. Realty Track reports that foreclosure auctions across the county have increased by approximately 11%, with Perth Amboy standing out as one of the areas experiencing the sharpest rise in foreclosure activity. Number 8. Toms River. Continuing down the Garden State Parkway toward the Jersey Shore, you expect to find the familiar energy of a busy coastal housing market in Ocean County. Instead, Toms River tells a very different story. What was once one of the hottest destinations for home buyers has slowed to a crawl, leaving many sellers waiting with little sign of renewed demand. During the pandemic housing boom, this community attracted waves of buyers searching for larger homes, quieter neighborhoods, and easy access to the coast. That migration fueled rapid appreciation and fierce competition. But in 2026, the enthusiasm that once drove this market has largely disappeared, leaving homeowners trying to sell in an environment where qualified buyers have become increasingly scarce. As you drive through these suburban neighborhoods, one detail immediately stands out. For sale signs seem to line street after street, many of them looking as though they've been standing in front yards far longer than anyone originally expected. The numbers reinforce what you can already see. Data from local multiple listing services shows that housing inventory has surged by roughly 34% compared with a year ago. More owners are rushing to list their homes, while buyer activity has slowed dramatically, creating an obvious imbalance between supply and demand. Recent Zillow figures tell a similar story. Over the past 12 months, the median listing price in Toms River has declined by approximately 7%, marking a significant reversal after several years of rapid price growth. Another troubling indicator is the market's absorption rate. According to Redfin, the average home now remains on the market for about 52 days before finding a buyer, a sharp increase from the roughly 20-day average seen just 2 years earlier. Homes simply are not selling with the speed they once did. Number 7. Elizabeth. Continuing north into the industrial heart of Union County, you arrive in Elizabeth. Given its location beside Newark Liberty International Airport and its close connection to one of the busiest shipping hubs on the East Coast, you might expect this city to be one of the more stable housing markets in New Jersey. In reality, the situation is proving to be much more complicated. What was once considered the price of convenience is becoming a growing disadvantage. Heavy traffic, crowded neighborhoods, constant congestion, and limited parking are pushing many buyers to look elsewhere, especially now that they can find more space and better overall value in neighboring communities. As you make your way through Elizabeth's busy streets, it's hard not to notice the increasing number of for sale signs scattered throughout the neighborhoods. Many homeowners appear eager to sell before prices weaken even further, suggesting that confidence in the local market is beginning to fade. The underlying data reflects those concerns. According to the New Jersey Department of Community Affairs, property tax appeals in Elizabeth have increased by approximately 18%. That trend suggests many homeowners believe their tax assessments no longer reflect the market's declining values and are challenging those valuations in hopes of lowering their tax burden. Pricing trends point in the same direction. Zillow reports that median home sale prices have fallen by roughly 6.8% since the beginning of the year, adding to the evidence that the market is steadily losing momentum. Affordability has become one of the city's biggest challenges. Data from the National Association of Realtors places this area among the least affordable housing markets when compared with local household incomes, assigning it a housing affordability score of just 85 out of 100. For many potential buyers, the numbers simply no longer work. That affordability gap has had a direct impact on sales activity. Compared with last year, transaction volume has declined by approximately 31%, leaving the market moving at a much slower pace than it did during the boom years. Number 6. Trenton. Turning south toward New Jersey's capital, you arrive in Trenton. As you pass the large government buildings and continue into the surrounding residential neighborhoods, the mood changes noticeably. The streets feel quiet, the pace seems slower, and there's a lingering sense that the housing market has been stuck in place for far too long. Trenton has faced economic and structural challenges for many years, but 2026 is exposing those long-standing weaknesses more clearly than ever before. Problems that were once easy to overlook are now having a direct impact on home values and overall market confidence. The city's heavy reliance on state government employment is no longer enough to offset the pressure created by high property taxes, aging infrastructure, and rising ownership costs. Those financial headwinds continue to weigh heavily on both homeowners and prospective buyers. Throughout many neighborhoods, the housing stock itself has become another obstacle. Large portions of the city's older homes require extensive renovations, and in many cases the cost of restoring these properties exceeds what owners could realistically recover when it comes time to sell. That imbalance has left entire sections of the market struggling to attract meaningful investment. The numbers reflect these broader challenges. According to the United States Census Bureau, the homeownership rate within Trenton has fallen below 38%, continuing a long-term decline that weakens neighborhood stability and reduces long-term community investment. Property values are following the same downward trend. Zillow reports that home prices have declined by approximately 8.2% over the past year, making Trenton one of the weakest performing housing markets anywhere in the Mid-Atlantic region. One of the biggest burdens facing homeowners is the city's tax structure. Effective property tax rates frequently exceed 4% of a home's assessed value, creating an expense that has become increasingly difficult for average-income households to absorb in today's economic climate. Records from the New Jersey Division of Taxation show that Trenton has the highest concentration of tax lien sales in the county, with those filings rising by roughly 15% compared with last year. In many cases, homeowners are losing properties not because they cannot make their mortgage payments, but because they are unable to keep up with mounting property tax obligations. Number 5. Newark. Turning back toward New Jersey's largest city, you enter Newark. Just a few years ago, there was a growing sense that the city was undergoing a true revival. New development, renewed investment, and activity centered around the train station gave many people confidence that Newark had finally entered a new chapter. In 2026, however, much of that momentum has faded. Driving through the ironbound neighborhood and into the surrounding residential districts, it's clear that the excitement surrounding the market has cooled considerably. The speculative enthusiasm that once fueled rapid appreciation has largely disappeared, leaving behind a much more cautious and uncertain housing landscape. Many investors who poured money into restoring older row houses are now holding properties that have lost value instead of gaining it. At the same time, the expected wave of millennial buyers has failed to materialize. Many have chosen larger suburban communities, while others have left New Jersey altogether in search of lower housing costs and a better overall cost of living. The data illustrates just how dramatically the market has slowed. According to the New Jersey Department of the Treasury, revenue collected from real estate transfer fees has fallen by approximately 22%, a strong indication that transaction activity has cooled significantly compared to previous years. Home prices have weakened alongside declining sales. Redfin reports that the city's median sale price has dropped by around 6%, while several of Newark's outer neighborhoods have experienced even steeper corrections approaching 10%. One of the biggest changes has been the retreat of large-scale investors. Speculative investment played a major role in Newark's housing boom, but that same capital is now moving in the opposite direction. Research from the Rutgers Center on Law, Inequality, and Metropolitan Equity indicates that corporate ownership of residential properties has peaked and is now gradually being reduced as institutional investors sell off portions of their portfolios. That shift is adding even more inventory to the market. Listing data shows that multifamily properties available for sale have increased by roughly 30% as larger investors continue to liquidate holdings, creating additional competition and placing further downward pressure on prices. Higher borrowing costs are also affecting traditional homebuyers. Records from the New Jersey Housing and Mortgage Finance Agency show that first-time homebuyer loan originations in this area have declined by approximately 40%. Without a steady stream of entry-level buyers, the normal progression of the housing market begins to break down, slowing activity across every price range. Number 4. Patterson. Leaving the waterfront behind, you head northwest into the historic streets of Patterson, the city long known as the Silk City. In 2026, however, the economic fabric that once held this community together is beginning to come apart. Even during stronger housing cycles, Patterson has faced persistent challenges, but the current market downturn is exposing weaknesses that run much deeper than an ordinary slowdown. As you pass the famous Great Falls and continue through nearby residential neighborhoods, the warning signs become impossible to ignore. Vacant lots filled with overgrown grass, boarded-up homes, and neglected properties appear block after block. This doesn't look like a market that is simply cooling after a period of rapid growth. It looks like one struggling under the combined weight of long-term economic and social pressures. The statistics reinforce that impression. According to the U.S. Department of Housing and Urban Development, the city's residential vacancy rate has climbed to approximately 12%, meaning that more than 1 out of every 10 housing units now sits empty. Vacant properties rarely affect only themselves. They often reduce the appeal and value of surrounding homes, creating a ripple effect that spreads throughout entire neighborhoods. Home prices continue to reflect that weakness. Zillow estimates show that property values have fallen by roughly 7.5% over the past year, wiping out much of the modest appreciation that followed the post-pandemic housing rebound. Foreclosure activity is adding even more pressure to the market. RealtyTrack reports that this area now has one of the highest foreclosure concentrations in New Jersey, with approximately 1 out of every 800 homes receiving a foreclosure filing during the most recent quarter alone. That level of distress places additional inventory into an already fragile market and weighs further on prices. Financing has become another major obstacle. Data from Equifax suggests that the average credit profile of mortgage applicants in this zip code has weakened considerably, contributing to mortgage denial rates approaching 25%. Even buyers who want to purchase a home are increasingly finding it difficult to qualify for financing. The slower pace of the market is equally apparent in listing activity. Local multiple listing service records show that the average home now remains on the market for roughly 78 days before selling, a significant increase that reflects declining buyer demand. Number 3. Atlantic City. You make your way back to the Jersey Shore, arriving in Atlantic City, a place that has always been defined by dramatic highs and equally dramatic lows. That same pattern now extends to its housing market, and in 2026 the cycle has clearly shifted toward decline rather than growth. The local economy has long depended on the casino industry, an industry known for its unpredictable nature. When tourism and gaming slow down, the effects ripple through the broader economy, and the residential real estate market is now feeling the full weight of that instability. Leaving the bright lights of the famous boardwalk behind and driving into the surrounding neighborhoods, the contrast is striking. Many homes remain on the market as sellers struggle to justify asking prices in an environment shaped by economic uncertainty, rising ownership costs, and growing concerns about long-term coastal risks, including sea level rise. The atmosphere feels very different from the vacation image Atlantic City is known for. Instead of optimism, there's a growing sense of financial uncertainty hanging over the local housing market. The numbers help explain why. According to the Bureau of Labor Statistics, unemployment in Atlantic City continues to run above the New Jersey average, remaining close to 7%. A weaker job market limits the number of permanent residents who are financially able to purchase homes, reducing one of the market's most important sources of demand. As a result, property values have fallen sharply. Redfin reports that median home prices have declined by approximately 9% over the past 12 months, eliminating a significant portion of the equity gained during the recent housing boom and leaving many recent buyers with far less value than they expected. Flood insurance has become one of the market's biggest challenges. Following FEMA's updated Risk Rating 2.0 methodology, insurance premiums for many coastal properties have increased dramatically, with some homeowners seeing their annual costs double or even triple. Those higher expenses make it much harder for buyers using traditional mortgage financing to qualify, placing additional pressure on home values. Local real estate organizations report that cash buyers now account for roughly 60% of completed home sales. Because financing can be difficult to obtain for certain higher-risk properties, the pool of potential buyers has narrowed considerably, leaving mainly investors and well-capitalized purchasers willing to assume the added financial risk. Financial distress is also becoming more widespread. RealtyTrack reports that foreclosure filings have increased by approximately 20% compared with a year ago, indicating that more homeowners are struggling to keep up with their financial obligations. Number 2. Jersey City. Heading east toward the Hudson River, you arrive in Jersey City, and this may be the biggest surprise on the entire countdown. For years, this waterfront market earned a reputation as New Jersey's Gold Coast, a sleek, high-end alternative to Manhattan where luxury towers seemed to rise endlessly and home values appeared destined to climb forever. In 2026, however, that narrative is beginning to unravel. Looking up at the skyline filled with gleaming glass high-rises, it's difficult to ignore an uncomfortable reality. A growing number of those luxury residences remain unoccupied, highlighting a market where supply has finally overtaken demand. Developers built premium condominiums at an extraordinary pace during the boom years, expecting buyer demand to remain just as strong. Instead, sales have slowed considerably, leaving the market with far more high-end inventory than qualified buyers are prepared to absorb. What was once one of the state's most competitive housing markets has shifted decisively in favor of buyers. The numbers illustrate just how dramatic that change has become. Market research from Miller Samuel and Douglas Elliman shows that the inventory of unsold condominiums priced above $1 million has increased by approximately 45% compared with a year ago. The luxury segment is now facing a significant oversupply that continues to place downward pressure on prices. As expected, values have begun to adjust. The median sale price for luxury condominiums has fallen by roughly 9%, making this one of the sharpest corrections anywhere in the New York metropolitan area. But declining prices tell only part of the story. The ongoing cost of ownership has become another major concern. Analysis of local listings indicates that average homeowners association fees have climbed by around 15%, driven by rising insurance premiums, higher labor expenses, and increasing building maintenance costs. Those larger monthly obligations are making luxury ownership far more expensive than many buyers anticipated. The rental market is softening as well. According to Zumper, rents for one-bedroom apartments have slipped by approximately 4%, reducing potential returns for investors who previously depended on steady rent increases to justify premium purchase prices. Large institutional investors are becoming noticeably less active. Redfin reports that investment purchases across Hudson County have fallen by roughly 50%, suggesting that many professional buyers no longer view the market as offering the same growth potential it once did. Luxury properties are also taking much longer to sell. The average high-end condominium now spends around 85 days on the market before finding a buyer, forcing sellers to continue paying mortgages, taxes, HOA fees, and other carrying costs for far longer than expected. Number 1. Camden. Our final stop brings us to the city experiencing the sharpest housing market decline on this list. Camden. Crossing the bridge into the city, you enter a community that has spent decades fighting to rebuild its economy and strengthen its neighborhoods. In 2026, however, those efforts are being overshadowed by mounting financial pressures that continue to weigh heavily on local real estate. Driving through the residential streets, one thing becomes immediately apparent. Many homeowners have seen so much value disappear that equity has become increasingly difficult to build, and in some cases it has vanished altogether. Home prices continue to weaken, leaving many properties worth far less than owners had once expected. Among all the cities we've covered, Camden stands out as the place where multiple economic challenges are colliding at the same time. Concentrated poverty, high borrowing costs, limited access to financing, and a sharp decline in private investment have combined to create one of the most difficult housing environments anywhere in New Jersey. The optimism that briefly emerged during the previous housing recovery has largely faded. In its place is a market where financial realities are dictating nearly every decision, and where sellers face increasingly difficult conditions with each passing month. The numbers leave little room for optimism. Zillow reports that home values have declined by approximately 11% over the past 12 months, making Camden the weakest performing market on this countdown. Home prices were already relatively low compared with much of the state, yet they continue moving lower quarter after quarter. Sales activity has slowed dramatically as well. According to the New Jersey Association of Realtors, the number of completed home sales has fallen by roughly 45% compared with 2 years ago, showing just how much buyer demand has weakened. Financial distress is becoming more visible throughout the city. Atom Data Solutions reports that approximately 1 out of every 600 housing units is somewhere within the foreclosure process, a rate roughly 3 times higher than the statewide average. Existing homeowners are also facing significant equity losses. CoreLogic estimates that nearly 18% of homes with mortgages are now underwater, meaning the outstanding loan balance exceeds the property's current market value. That situation leaves many owners trapped, unable to sell without taking a loss or refinance under favorable terms. Mortgage financing has become another major obstacle. Federal lending data indicates that nearly 40% of mortgage applications submitted for properties in this zip code are being denied, preventing many qualified buyers from entering the market and further reducing demand. Investors, once an important source of housing activity, have largely stepped away. The gap between renovation costs and potential resale prices has become too wide for many projects to make financial sense, causing acquisition activity to slow dramatically.